Hello everybody, welcome to the Cafe of Knowledge. We on chapter 16. We on chapter 16 today. Okay, so let's get right on into chapter 16. Thank y'all for tuning in today. Please hit like and subscribe, please. Please subscribe to the channel. If you haven't already, please subscribe. Chapter 16, we are going to talk about the balance sheet. Okay, and remember I was telling y'all a couple of weeks ago that the balance sheet will be coming up. You all know what goes on a financial sheet now. Now we're doing the balance sheet. And the balance sheet basically deals with the money. Okay? You're dealing with that balance sheet's just going to have everything that's pertaining to the money side of the business basically only. That's all that balance sheet really going to have on it. Everything that's dealing with the money, okay? It focuses on the money. Let's put it that way, okay? So now, this balance sheet, you're going to start off with cash, okay? So now, that's basically the bottom line. The balance sheet deals with the cash version. The cash, anything that's dealing with the cash, okay? So now, the cash is the most important part of the balance sheet, and it is. The cash is the most important part of a balance sheet. And it's the most complicated task that a company has in keeping track of the money, okay? Some companies keep cash in different locations, so keeping track of the money in multiple locations can be a very difficult task, meaning that it might be a company that, you have, if it's a company and then that company only has like one location, one store, then, it's kind of easy to track the money and keep up with the money, to make sure that everything is going smoothly, like everything is being deposited and things like that. If a store has multiple stores around, if a company have multiple stores, like they'll have one store, let's just say an E&J store. It's called E&J, and say it's an E&J store in one city, an E&J store a couple of miles away, it's another E&J store. Then you go into another city, it's another E&J store. If you go into another state, it's another E&J store. Okay? Now, you have to keep track. That's what the balance sheet is for. And usually the accountant's person that's working for that company keeps up with this. The accountant person usually keeps up with the balance sheet. Okay? And they do a balance sheet every day. They don't miss a day because money is coming into that company every day. Okay? So now, say they got 4 different locations. Okay? It's an E&J here, E&J there. It's 4 different NJs in different locations. Well, that accountant has to make sure that the money is balancing out in all those 4 stores. Okay? They have to make sure that all the deposits are right. Ain't no deposits missing in none of those stores. They have to make sure that everybody is making sure that what the cash registers say they should have in money at the end of the day, that's what should be in that bank account at the end of the day. Okay? So that's what they meaning by when you have different locations for its cash, it's kind of hard. It becomes a difficult task to keep up with all those stores. Now, granted, it's done. A lot of people execute it very, very well. And then you have some accountants that don't do very well keeping up with it, and then that causes the company to eventually go bankrupt and all that because they're not keeping up with the paperwork exactly like it should be. That's why we do this today. I'm showing you how to keep up and what should be on that balance sheet, and that balance sheet deals with cash. So you want to make sure that all those locations have exactly the amount of cash it's supposed to have every day. Okay? And one store might have made $1,000 today, And then the other store might have made $2,000 that day. The other store might have made $3,000 that day. Well, you have to make sure that each one of those thousand from this store is in the bank account. And it could be account for it. And then that other store, you go look and make sure, yeah, they deposit their $2,000. Then you look at the other store, okay, they made $3,000 yesterday. Then you look at the bank account, yeah, they did deposit $3,000. But if one of them if the one that's supposed to have $3,000 deposited $2,500, then you like, that store is missing $500. Let me call and see what's going on. Okay, but they're gonna have to account for that $500. Okay, now so that's why they say that keeping track with the cash in multiple stores, it's a difficult task. But hey, that's what you have to do. Okay, now companies must have a way to track its cash and they have to know exactly how much it has at the end of each day. Okay, so at the end of each day, like we said, in businesses, after they get ready to close down, they run an end of the day report on the register. We already went through that. If you don't know about it, please refer back to our other videos, but we have already talked about how the cash register paperwork goes. Okay, so at the end of the day, they do an end of the day report, and that end of the day report tells exactly what was made that day in that store and how much money that store made that day. And that is the money that needs to be put in a bank deposit bag or slip and deposited into the bank account. Okay, so that's how you know what a company makes each day, because it's going by that register report. Okay, and then it says most companies track their cash several times a day. Companies that have a high volume store, which is very busy. If a store is very busy, they do tend to count their cash multiple times a day. Okay, this is so that they can keep track of it. Say like some stores have it to where, when they have multiple stores and their stores are very, very busy all the time, non-stop, it might be 1 or 2 hours worth of slow time in there, but it's generally a busy store or busy company. That's when people inside of that store, the management team or whoever, they count their money just about several times a day, probably twice a day or 3 times a day. Some of them are counted around about noontime. They'll count all the registers, all the drawers, everything. They'll count the safe just to make sure that everything is in there. If the safe started off this morning with $1,000, it should still have $1,000 in it. And then if the register says so far this store had made $1,000, well, after they count all the registers up, it should be $1,000 in those registers. Okay, and then they'll wait. Say they do that at 12 o'clock, then they'll wait till about 3 o'clock, 4 o'clock, and then they'll do it again. They'll count all their money again. But that's because they are making sure they always keeping track with the money, because the store is so busy. Okay, and you just have some stores that's their policy, that they do count their money about 2 or 3 times a day. Okay, now the person tracking and counting out the cash drawer must show the cash amount matches with the total day's transaction report. And I just said that if that transaction report coming out of that register at the end of the day is called end of the day sales, it'd be a button on there, and all registers usually have an end of the day button. And it's created when you first buy the register. It shows you how to program that in. Okay, but when that transaction, when that slip comes out at the end of the day, and it says, I just already said that, if it says this store made $1,000, well, it should be $1,000 in that register. and then you deposit that $1,000 into the bank account, into the bank. Usually management team is somebody in management that will go to the bank and drop the deposit, in, and then when they drop the deposit in, it automatically goes into the corporate office or whatever, so that accounting person who handles the balance sheet will be able to put that on the balance sheet. They will see how much that store made, and then, yep, they did deposit that amount inside the bank account, so they are good. And then they also have to put the management team have to put what's inside their safe, how much money is inside their safe. If it's $2,000 inside their safe, the management team have to count it, sign a log, and then they have a witness right by them to verify that, yeah, it is $1,000 or $2,000 in that safe. They both signs it off. And then they also ship all that paperwork at the end of the week to the accountant, and then that accountant puts all this stuff on the balance sheet. So that's what a balance sheet is really for, to track the company's money down, okay? So all companies' balance sheets looks different, but no matter how different it looks, maybe it's going across or maybe it's going down, no matter how different it looks, it's going to have the same thing on it, okay? The cash part, okay? And you know how to do it. It'll say total cash that the company have. And you have to, that balance sheet adds up. If it's just one store, it adds up just all the one store cash. If it's multiple stores, they add up all those multiple stores, and then they put it on the balance sheet, okay? All those different stores, they add up, because that the balance sheet lets everyone know how much money that company made that day from all those stores, okay? So that's what a balance sheet does. And the balance sheet is normally done by the accounting person who is working in that corporate office, okay? And if it's just one business, and say they don't have a corporate office, say their accounting person office is, inside of that facility, that's what that accounting person is doing. They doing that with the balance sheet, and they're putting everything on that balance sheet that's pertaining to the cash, okay? So now, you know about that, and it's all companies' locations need a bank to deposit receipts and get cash the company needs to operate their business on a daily basis. So, your store usually gonna have a bank right next to it that it deals with. Not too far away, no more than like a block or two away is a bank that they deal with. And that's the bank that the management team deposits all the money into, okay? And it's also a place where the company can pull money out of, okay? So all of this goes on that balance sheet, okay? Managing cash is one of the hardest jobs for a company and a business, because cash can easily disappear if the proper money procedures aren't in place. And that's why companies have such a strict rule with the deposits and the cash. They tell you, hey, you need to deposit the money right after a certain time, or about 2 or 3 o'clock in the afternoon. All deposits need to be going in the bank. 11 o'clock in the morning, all deposits need to be taken to the bank by 11 o'clock. And then after they take all the deposits to the bank by 11 o'clock, then they have a rule that, okay, all deposits need to be in the bank by 3 or 4 o'clock. And all the deposits. So everybody has a rule, no matter where you are working at. And if you're dealing with the cash inside of that store, they will tell you your rules, when each deposit is supposed to be done. 2 people are supposed to be standing there verifying the deposits. When you counting the cashier drawer, like some cashiers that come in at 8, get off at 3, and when they get off at 3, that manager and the cashier got to pull that drawer out and go into the office and with the receipt from the register that says what this cashier made for that day on their shift. And then they take that receipt. That receipt probably say, hey, this cashier should have $1,000 in this drawer because that's how much money she's made today on her shift, $1,000. So when y'all get to the office, both of you count the money and make sure it's $1,000. And if it's $1,000, then that's when the manager puts it into a deposit bag and seal it up, put it in the safe, because the next time that everybody makes it, or the management team make a trip to the bank, that deposit goes to the bank. Okay, so that's how they keep track of it, and that's why management teams are so strict on cashiers when their registers are short, and if the registers are short and they can't account for it, then that's when a cashier will get a reprimand. They will get written up or corrective active, write-up sheet, and to limit that shortness. Okay, so all of that is what a balance sheet has on it. And that balance sheet's going to have a cash for every location. You got to put with every location what they had in cash that day. Okay? Each and every day. That's all that person does, that accounting person do, is keep up with the balance sheets, the financial sheets, and the annual sheets. And we'll be talking about annual sheets coming up too. But they just make sure that all these things are in place, okay? And companies and business must have consistency in following all money procedures properly. This includes making sure that all daily cash registers balance. We just talked about that. Petty cash balance. Petty cash is usually when the company or the store has about $200 inside the safe that's for emergency uses. Petty cash. Meaning that, say, if you run a restaurant and y'all ran out of paper plates and the truck don't come until tomorrow, well, to bring you more paper plates, then you would have to go into the petty cash, where it's about $200, take out about $20, and then go buy some more paper plates. But you got that receipt. Whatever change you got and the receipt has to go back into that petty cash, because that receipt and the change will balance it back up to $200, okay? And then at the end of the month, that's when the management team take all the receipts out of that petty cash part, put it inside an envelope and ship it to corporate, and then corporate will see that they spent probably $20 or $30 out of petty cash, and then corporate will make sure that they send that money back to that store to replace that. But as long as they have something to show for why they used it, then all good. Okay, so that's what you call petty cash. It's for like little emergency uses. If the stapler broke and it's not another stapler, and then you send somebody to the store to go buy a stapler, and then if the stapler costs about $6 and you gave them $20, you know what I'm saying? Then the people have to bring you your change back with the stapler, with the receipt. And then you put the receipt and the change inside the petty drawer so it'll balance. So that's what companies have to make sure, that all their daily registers balance, the petty cash balance, they bank deposit balance, of course. They have to make sure that they deposit log balance, because when you do a deposit, they'll have you sign, $1,000 is what this cashier had, and the cashier signed their name, and then the manager signed their name, and then they put it in a bank bag, and the bank bag usually have a number on it. You got to write that number of the bank bag that you got that $1,000 in you. And that bank bag might say 11222. You got to put 11222. Bag has $1,000 in it. And then you got to write the date, the time, you sign, the cashier sign, and then that's on the bank log. And so you will give that to the accounting person at the end of the day, or at the end of the month if they require you to send it in at the end of the month. So that's how that goes, okay? And it's always supposed to be two people witnessing any type, even the cashier draw is supposed to be the cashier and the manager. It's always supposed to be two people at all times with two signatures on everything. You know, and if you're counting the safe, it's supposed to be two managers counting the safe. What, both of you don't have to count it, but one have to be standing there looking to make sure that what you counted is correct. Okay, and then you have both of y'all write that down too. Okay, but all this stuff goes to that accounting, and that accounting person puts all this on the balance sheet. Okay, so this is all goes on the balance sheet, and that's what then the accounting person usually takes care of the balance sheet and put every single penny and cash that company has on that sheet every day. Okay, so that's the biggest part of a balance sheet is the cash part, and I just explained that. And then it'll be a line on the balance sheet that says short-term borrowing. Short-term borrowing is when a company has borrowed money, cash. When a company has borrowed cash from a bank or from investors or whatever, when they borrowed money to help with their cash issues. Like if that company borrowed some money for some reason and they went to a bank and borrowed money to help out with some money issues they was having or to pay vendors or whatever, then that's a short-term borrowing. So you have to put that on that balance sheet, because the balance sheet is going to have cash, like we just discussed. Then it's going to have short-term borrowing, and you're going to have to put what bank that this company borrowed money from, how much, and when is it supposed to be paid out, and how much have y'all paid so far, and how much is the balance left on whatever that company owes to that bank or that investor. Okay, now then it'll have up under that long-term debt. Current portion of long-term debt should be on the next line, and that's when a company has to pay for a loan or something for more than 12 months. You know, that first one, short-term borrowing, means that the company borrows some money from a bank or investor, but they're going to pay that back within the next year. That's a short time. Anything that they pay within the, they're going to pay out within 1 year, that will be on the short-term borrow. If they borrow money and it's going to take them longer than a year to pay off that loan, that one will go up under current portion of long-term debt. Okay, it will go up under the long-term debt, and you will put who the company borrowed the money from, what bank with the name of it, or what investor, the name of them, and then you will put how much they got from them, and then you will put how long the payments are, like how many months that the company had to pay for it. You will put the interest rate that they got on there, that the company is paying what type of interest rate, and you will put that down there. And then you will put how much has the company paid so far, how much money is left to pay them before the loan is completely paid off. Okay, so that's what that is. Then it'll be another line on the balance sheet that will be for stocks. You know, so any kind of stocks that company have, if they have any stocks, you will put the stocks, what the company have in stocks, then what their common stocks are, what their preferred stocks are. Any type of stocks that a company have will go under the stocks part. Okay? Now, then you will have a line for drawing account. Drawing account. Listen to that real closely. Drawing account. This section This is the section that tracks any money that the owner takes out of the company's annual profits. This is used in unincorporated business. So if it's an unincorporated business, then you would put down drawing account. And unincorporated, you have a corporated business, then you have an unincorporated business, okay? And usually it's for a smaller business. That if the owner just comes in and then like they pulling money out the bank account, because the accountants will see that everything matches in the bank account, but then also when money is drawn out of the bank, then it shows that. And it may say that the owner drew out $200. Well, that accountant has to put that on the balance sheet. Owner drew out $200. Now, it's going to have for what? Now, just because you own a business don't mean that you could just go in there. It's not supposed to be like that. Now, you got some business owners that just do it because they can, but it should be ran the proper way. When you own a business, if you take some money out of that bank account, then if you take $200 out of it, then that accountant's going to put down there, okay, $200, and it's going to show who drew it out. And then it be the owner drew it out, and it was $200. Then the accountant, it's a spot on there that says used for what? And then you would have to go to your boss or whatever and say, hey, I see that you pulled $200 out. What do you want me to put on the balance sheet that it was for? And then they'll tell you what it was for, and then you go back and you put on the balance sheet. But you have to have it like that, and because it has to balance. Because $200 can't just be missing out of the bank account, and you don't put it on the balance sheet, because then your cash is not going to balance. So everything that comes in and out goes on that balance sheet. Anything that goes in the bank account comes out of the bank account of that company's need to be on the balance sheet. So that is what a balance sheet is for. So if you have any, if you don't quite understand it, please rewind and go over it again. And then if you have any more questions that maybe you think I didn't cover, and then you did go back and look and you still didn't get a good understanding, always email me at cafeofknowledge88@gmail.com. That's cafeofknowledge88@gmail.com. And you can always send in a little message or email, and I'll be glad and sure quickly refer to you with that question. If you have one or concern or whatever, I will go over that real quick for you so you get a better understanding. But please make sure that you refer back to the video to make sure it hadn't already been discussed in this video, okay? But that is what the balance sheet is for. So now you know what a financial sheet has on it. Now you know what a balance sheet has on it. And we will be doing an annual sheet as well. And that's when a company for the whole year has to put everything on this sheet. What that company did for the whole year, that's what go on that annual report. Because that annual report will be most basically for that company to know how much they made all year long or how much they lost all year long, and for their tax purposes and everything like that, okay? So just make sure that y'all have a good understanding out of that. Let me see if I missed anything here. And them long term. Let me go over that, because you know when I said the balance sheet, you know what the short term borrowing is going to be a line for that. That's anything that the company borrow from anybody, but they will pay it back within that year. Like, you know, it's going to be, that loan is going to be over with. They're going to be done pay that loan off within a year. That long-term debt one is where the company is going to be paying on something longer than a year. Now, I'm just go over what that is. Sometimes And that long-term debt is things that the company hasn't paid yet, but they have a long-term debt on it. Like they paying on it, it's just not paid out. Okay? And that would be things like the accounts receivable or the account payables. Say it's some account payables inside of the drawer when the accounting do the balance sheet for that day. But these bills here are not due yet. Your accounts payable, like you got your accounts receivables, you got to pay them, but it's not time to pay them yet. Well, that will go up under, your long-term, like employees, they payroll, that when you filled out the balance sheet, the employees wasn't paid yet. Like that week coming up, they hadn't got that check yet because it's not time for them to get paid yet. Well, you got to put all that up under there too, about how much that you go owe all your employees for that week, or that week, because that balance sheet be done every day, and then they do one for the whole week, for each week 1, week 2, week 3, week 4. Okay, so we already talked about that in previous videos about how the week 1, week 2, week 3, week 4 folders go. Well, that's the same way accounting have their week 1 through week 4 folders as well. And when they get to that 4th month, they will put everything down there that they need to put for as if they owe any employees, or if the long-term debts. This is for the long-term debt part. They'll put down the long-term debt. They'll put down accounts receivables that haven't been paid yet but have to be paid. They'll take that. They'll put all that stuff up under there. So that's basically what all of it is dealing with, the cash. Okay? And so that is what the balance sheet has on it. It will have all them things on it. And of course, when you do start an accounting job, or you working in a company that has 2, 3 different location stores, they have like 3, 4 stores, you know how to keep track of it. And on the sheet, it'll have the line, like, okay, cash. Then you got to put all the deposits and stuff in and all that stuff. And then it'll say, okay, short-term borrowing. Okay, what is y'all short-term borrowing? You look it up and then you put that on the sheet. Long-term debt. Then you got to see what the company's long-term debts are. Then you have to put that on the sheet. Okay, and then your drawing account, meaning when the owner comes and they pulling money out the bank, then you got to put that down there too. Okay, so all these things is on the balance sheet, and when you do get the balance sheet, you will know exactly where to plug everything at. Like I said, I can't really show you a draft of a balance sheet, but I did tell you what is all on a balance sheet and what all you have to put on the balance sheet. If it say cash, you already know what you got to fill in for the cash part, and it'll have it all down there. And then it'll have exactly what you need to have for the short-term borrowing, and then how you fill it in, and you know how to do it already. Okay, so that's all we have for today and for chapter 16. That's it, and see y'all next week for chapter 17. Okay, so gain knowledge to prevent blockage, and you all know what that means. The more you know, the harder it is for anybody to block y'all from y'all goals and success. See y'all next week. Bye bye. Y'all have a great week.